Are Alphabet's glory days over? That is the question that the author of this piece here on Seeking Alpha tried to answer. He began his piece by saying modest alpha to be found in Alphabet. And the summary of the whole piece is that the recent quarter highlighted that the center of gravity for ad dollars has shifted a bit from Alphabet being the center of the digital ad solar system. This was evidenced by Facebook and Amazon's ad segments growing, while Alphabet's core search business declined on the top line. In this note, he wrote, he tried to answer the questions: are Alphabet's glory days over, and what should one do with Alphabet's shares? And ultimately, he found that Alphabet's glory days are not numbered, and one should view Alphabet as another new value play for the 21st century. And he performed a forward-looking sum of parts valuation on Alphabet so as to demonstrate the extent to which one could generate modest alpha from purchasing Alphabet. So the first section of the piece is his investment thesis, and he wrote, in the wake of a quarter in which Alphabet was clearly bested by its peers, that is Facebook and Amazon, in terms of attracting new ad spend, I have received many questions germane to the prospects of Alphabet to outperform the S&P 500 and Nasdaq over the coming decade. Then he went on to discuss a few factors that he sees at play, which inform whether he would invest in Alphabet. After which he performed a sum of parts valuation using L.A. Stevens' valuation model to illustrate whether an investment in Alphabet makes sense as of today when the shares are trading at $1,500. And then I think that may be a caveat. The aforementioned factors are the intersection of which Alphabet currently conducts business. So I suppose, though management has not made egregious errors there hitherto, as we've seen, for example, AT&T, with managers frittering away shareholder dollars, we must remain extremely skeptical of Alphabet's management. This is not impersonal, this is just good business, as you can read here and here. Digital advertising is on an inexorable path towards a $1 trillion spend yearly by the 2030s. Although Alphabet finds itself serendipitously at the center of this trend via search and video, data center spend is also on an inexorable path towards $1 trillion by the 2030s, at the center of which, again, Alphabet finds itself. The gravity of ad spend is obviously shifting as advertisers continue to spend more and more with Amazon and Facebook and social media at large, as evidenced by its rapidly growing other segment and evidenced by Facebook's growth in ad revenue in the last quarter. So from that, we can take away two clearly defined pros: a clearly defined con and what could become a con. Pros: digital ad spend and data spend center spend continue to rise rather unabated. despite a terrible macro environment. The cons: Alphabet does not have its visionary original leadership at the helm, as is the case at Amazon and Facebook, and there seemed to be a steady stream of controversies emanating from the whole of Alphabet over the past few years. Facebook and Amazon continue to capture a great deal of ad spend, and with the advent of connected TV globally, ad spend could further gravitate to other players such as Roku and the Trade Desk. So he's a bit concerned about growth rates for Alphabet's historical cash cows, that is core search and Google properties. And then valuation. With all of this being said, we can all vote how much we like or dislike Alphabet for one congressional hearing reason or another. Ultimately, however, the market is a weighing machine, and over the long run, will ignore the noise and weigh the cash flows. Okay, so if you're familiar with the model, that's the L.A. Stevens valuation model. Uh, he housed a specific set of valuation techniques under one roof, which he dubbed a previously liberated moniker, so as to project the weight of the company over the long run. So let's weigh Alphabet with 166 billion of revenues. We're going to need a pretty big scale. Valuing Alphabet using sum of parts technique, Alphabet inevitably suffers from what's known as the conglomerate discount or the diversification discount. This is a phenomenon where the market discounts the value of individual businesses while they are housed within a larger conglomerate. Such the case of every large leviathan, such is the case here with Alphabet. And with that being said, let's remember that the market is a weighing machine, and ultimately the cash flows that are generated from these parts collectively will drive the share price of Alphabet high. Okay, so these are some of the steps. In step one, we have a traditional DCF model with cash flow to equity discounted by our shareholders' cost of capital. Step two, the model accounts for the effects of the change in shares outstanding. And three, normalizing valuation for future growth prospects at the end of 10 years. 3A, then using today's share price and the projected share price at the end of 10 years, we arrived at a CAGR, in which if this beats the market by enough of a margin, we invest. If not, we wait for a better entry point. If the company pays a dividend, my model accounts for the returns that will be generated from such a dividend and growth thereof. It does this by identifying a target payout ratio and using the present dividend and the growth thereof to create an additional projected return atop the share price return we can expect. Identifying the parts: Alphabet's trailing 12 months disaggregated revenues as follows: Google search and other YouTube ads, okay, Google properties, Google network, Google advertising, Google cloud, Google orders, Google revenue, and all that. Okay. So the following table provides a reclassification of revenue and certain assumptions for each business segment. Okay, so this is Google, YouTube, GCP. GCP is a Google Cloud platform, and all that, and all those. So notes related to assumptions above. In order to arrive at the FCF margin for Google, which includes Google search and Google network revenues, he used a bit of algebra. Operating margins and therefore free cash flow margins are easy to identify in YouTube and GCP because Most notably, we have many pairs from which to draw conclusions in the data center and social media universe. So he solved the he solved for X, that is Google, after estimating the other segments, free cash flow per share. Other includes Google other bets and hedging gains. Valuing the parts. After identifying the conservative cash flows that could be generated from Alphabet's individual business segments, we can now value these segments. For the sake of space and all of our sanities this fine Wednesday morning, he created an appendix at the end of the research note, which, okay, yeah. Below is a summation of our results. Okay, so what are the concluding? We're just going to go ahead and look at the concluding remarks. Aside from Amazon, there may not be another company standing at the heart of so many other secular growth trends in such a seemingly perfect fashion. Secular trends like social media and democratization of media production, and as manifested through Alphabet's YouTube property, the explosive growth of digital advertising, which remains it may be the second or third inning, and the rise of cloud computing, which is also likely in its second or third inning, will continue to power shares of Alphabet higher. However, potential missteps in execution by management and new, very strong entrants into the digital ad market will create headwinds for Alphabet's overall growth, which may lead to market perform or just marginally outperform. Margin of safety defining what we compete against and the market's new value plays. With all the above being said, I don't view Alphabet's prospects for outperformance as extraordinarily exceptional. But in so saying, he is reminded that we must identify that against what we plan to compete. Okay, if we are planning to compete against the S&P 500 index fund, then I am quite confident our Alphabet will outperform. If we are competing against the triple Q, then the prospects are a little clear to me. There simply isn't enough margin of safety at today's today's share price for me to feel confident in the company's ability to outperform triple Q over the long run, despite it operating at the heart of the three most important secular growth trends of our time. Furthermore, he believes Alphabet and Amazon, for that matter, perfectly highlights what value plays look like in 2020. A value play is not oil and gas, which he believes are doomed to perpetual underperformance, as he has described there. Okay. Valuation appendix. Okay, I think we'll just include this link for you to have a look yourself. We'll definitely include that, and then we just come over here and have a brief look at the charts, and we can see that it has had a V-shaped recovery from V-shaped recovery from the 19th of February up till date. It's a perfect V-shaped recovery from decline from that 19th of February. That was when it started to decline, and at that time, as a matter of fact, the price of the share price was $1,527, and it has even reached what is that price over there? Let's see. Let's get a better picture of that. And okay, 1,563. So 1,563 and 1,000. 527. So even before the lockdown, it didn't have as much as it had as at the 22nd of July. Okay, so but from since that 22nd of July, it's been very much side trading sideways. You can see the 20-day simple moving average, a trend line. It's not indicating that there is very much momentum in the upward direction. More of a decline as a moment, as a matter of fact. And so even at some point in June, the 26th of June, it actually dipped below the 50-day moving average. And yes, even also as recent as the 4th of August, it actually traded below that 50-day simple moving average. So it's been a source of support of late, and since this month, it's been a source of support. And since also trading below, since dropping below the 20-day, that was the 31st of July, it has not gone beyond it. So that's really interesting. And since we have this 10-day, 20-day simple moving average, you can imagine that the 10-day would also be somewhere slightly above that 20-day. And yeah, we all know that the Nasdaq has been having some rotation. Sorry, the markets have been having some rotation. It seems the funds have been flowing away from the Nasdaq, which has been the outperformer of late, and into the S&P, and probably of recent the Russell shares. And then you can see here what it's going on. The MACD is definitely showing that steam has run out almost completely, and just barely trying to dip below negative figures. And then the RSI is also indicating poor, low, weak strength as well. Okay, so thank you very much for watching this video. Don't forget to subscribe to our channel and hit the notification bell, and also do well to sign up on our platform, Equity for Keeps. You can find the description, the link in the description box below. Thank you very much again.